So if you add all of this up, you got the plus positive deltas on the shares that you purchased, you got negative deltas on the call that you sold, you got negative deltas on the put that you bought, and if you add it up, it's going to be plus 50 in this example. So that means you are long 50 deltas. Let's now talk about the collar setup and adjusting the collar. All right, so the setup of the collar. We're going to jump over here and I'm going to go into the UPRO. And I'm going to just use the 14 days to expiration for the UPRO. And the reason why I'm going to use the UPRO to kind of point this out, two factor. The options are good and it's reflecting the S&P 500. If you want to make your collar trading successful and as stress-free as possible, start doing it on an index, an S&P 500 index. It's several ways you can do it, but a very clean and low cost way, and I know low cost is relative, is using the UPRO. If you use the SPY, as you can see here, if I put in the SPY symbol, it's over $637 a share. So that's going to cost you over $60,000 to buy 100 shares. It's costly at this point. If you go into the UPRO, it's going to be less than 10,000 at this point because it's going for $98 a share. We can just say 99. So less than 10,000. That's a big difference. And the UPRO is outperformed the SPY over the last 5 to 10 years. It's a leveraged product, but if the market is going up, which it does the super majority of the time, this UPRO is going to outperform. This is unlike most type of leveraged ETFs that they have principal erosion. This does not. It hasn't had a reverse split or anything such as that. This is, in my opinion, just as safe, if not safer, than the SPY. If you're collaring it off, it's definitely safer. So when you're going to set up the collar, you're going to set up the time frame that you want. Here at Dorian Trader, we talk about 7 to 35 days. Can you do it longer? Absolutely. But most of the time, we're doing it 7 to 35 days. In this example, I'm showing 14 days to expiration. The collar consists of 3 parts. Part 1 is the shares. Part 2 is the call. We're just going to say short call. When I say short, I mean you're selling the call. Part 3 is the long put. When I say long, I mean you're buying the put. If you buy 100 shares, that equals 100 deltas. Each share equals 1 delta. So if you have 100 shares, that equals 100 deltas. Bullish deltas, because if you buy shares, that means you're bullish. You want it to go up. When you sell a call, you are bearish. Basis of options, everyone. If you sell a call, you're bearish. You want it to go down, and you have an obligation. When you sell calls, you have an obligation to sell shares to the buyer of the call. When you sell that call, the delta that you sell it at is negative. That's giving you negative deltas. So let's just say you sold it and you received 25 negative deltas. When you buy a put, you have a right to sell the shares at the strike price. You do not have an obligation. You have a right to sell at the strike price. And you're bearish. When you buy a put, you're 100% of the time bearish. When you buy that put at the delta, that delta is going to be bearish deltas. So let's just say you bought the put at the 25 delta. So if you add all of this up, you got the plus positive deltas on the shares that you purchased, you got negative deltas on the call that you sold, you got negative deltas on the put that you bought, and if you add it up, it's going to be plus 50 in this example. So that means you are long 50 deltas, or you can think of it as having 50 shares. You no longer have 100 shares, you have 50 now when you sell this put in this, when you sell the call and buy the put in this example. So the collar strategy is bullish. It's always bullish. You can make it more bearish. You can make this trade less bullish, as you can see with these deltas. You can go down to, 1 positive delta if you wanted to, but it's still going to be bullish. You want it to go up if you're doing a collar strategy. Now, once you understand that, you can set it up based on your assumption. So if we go over here and we have 14 days to go, and we thinking about the S&P 500. Do we think it's going to go up over the next 14 days? Do we think it's going to be flat? Do we think it's going to go down? You got kind of 3 options and then some nuances between those 3 options, right? Because you might be bearish, leaning a little bullish, right? Or you might be neutral, leaning a little bearish. I know that sounds weird, but it's not all just black and white on your assumption sometimes. Before we continue with the video, I just want to quickly point out, if you need any additional help, please consider joining our trading club. You can do that by clicking on the link in the description area, and you'll get a 3-month trial for a flat fee of $60. We look forward to seeing you in the trading club. Back to the video. If my thought process was kind of neutral over the next 14 days, then I can set up the collar by first starting with the covered call, because a collar consists of a covered call and then you're purchasing a put for less than what you sold the call for. So in this example, we were up quite a bit today. We've been up quite a bit for the last, let's say, 3.5 months. And so if I'm neutral over the next 14 days, I could decide, okay, I'm going to sell this 30 or 32 delta call here at the 102 strike that you guys can see here. And then what I want to do is buy a put for less than what I'm receiving here is about 122. So if I go over here, I can buy the put. The put that I'm buying here is cheaper than the call that I'm selling. So you can see that I'm receiving $30 here in overall credit for the option part. For these options, I'm receiving about $30. But if I go down here and break down the kind of information that TastyTrade gives us on this, it's saying that it's going to be some buying power of 7,300 to do this trade. My max loss potential over the next 14 days is just over $600. My max win is about $340. The deltas that I have on this trade after you take the shares and the put and the call into account is a positive 48 deltas. And then, as I said, I'm getting about $30 in extrinsic based on the options. So if I'm neutral, maybe this is the trade that I want. I'm still bullish overall, but I'm not 100 deltas bullish. I'm 50 deltas, just under 50 deltas bullish. I can still get some upside, about $340 worth of upside, and then I can protect myself to the downside. The most I can lose over the next 14 days is $600. And if you trade this strategy the way we teach, you're not going to have to realize that $600 loss if it drops that much. You're just going to continue to roll the options. And so that's what we're going to discuss now, is adjusting the options. Once you put on the trade, and I just say, things go wrong. What happens, it doesn't go wrong, it goes right, whatever happens. It's 3 ways I want to discuss at this point. Number 1 is that the option is in the money on the call side. Let's just go out 7 days. It's not the greatest example that I would like to see. We're going out 7 days, and we're going to say that the call is in the money. And let's say the call is in the money at the 86 delta here, 86, 85 delta. 7 days ago. You could just let it play out and let it expire in the money if it stays this way. You have won. When it's in the money because the collar is bullish, you have won in this scenario. But let's just say you want to roll the options. Well, if you had a put down here, and let's say the put is basically worthless way down here, probably less than even that. What you're going to do is reverse what you did. You're going to sell the put because you bought the put. You're going to buy the call because you sold the call. In this case, it's going to be a $6.20 debit. If I went out 14 days, I can decide just to reposition the trade based on the new expiration period, because I've already won on the 7-day period to this point. It went up. It's in the money a lot. That means I've won on that call side. So moving the options to this next expiration period is like resetting the trade completely. It's almost like taking it off and putting it back on. It's not almost, it's exactly like that if you did the math. We're not going to do that now, but trust me on that. We talked about it in the past. I want to kind of focus on the 3 type of adjustments though. So in this example here, we could keep the call where it's at, sell it at the 94, and then buy the put at the 86. Right? That's where the put was at. So if we did that, it's an overall credit of $35. But that's the most we can make over the next 14 days but you do have this option. Sometimes obviously it's not going to be in the money. Sometimes it might not be in the money and decide to stay at the same strikes. That's fine. This will be an overall credit on the trade if you did it that way. If you decided to move the options, and then just say you decided to just reposition some and you moved the call to the 96 and you brought the put up to, let's just say you brought the put up to the 93. Well, in this case, it's an overall debit, but you are getting a credit for the new trade, the new expiration period. I don't like this type of setup though. So the way I would normally do it is the second type of option and just reposition the trade. And so in this example, let's say I decided I was going to put the call at the 105 and just make sure I get more than what is giving me here, which is 160, and this is 105. So this is the trade. Yes, it's an overall debit, but you're getting a credit on the new trade. It's like starting all over, repositioning. And so if we break down the math, how does it work? Well, in this example, with 7 days ago, you were at the 93 strike. So 93 plus, or 101, I should say, minus the 93 is $8. Okay. So we got $8 difference there. So 8 times 100 is $800. Right here, it's costing us five 557. And plus we're getting this kind of extrinsic here, as you can see, plus 20 cents. So what we have here is this is how much we can make over the next 14 days. We can take the 800 minus the 557 plus the 27. It's going to give us another $270 we can make over the next 14 days now by readjusting that. But we also reduced the risk to the downside now, because we went from an 86 put to a 93 put. So if it drops now, we don't stop losing at 86 anymore, just we have the right to sell at 86. We now have the right to sell at 93. This is a way to kind of adjust this. And the third way to adjust it is to just say it was in the money. Let's just flip this all, and let's go back to the 7 day, and let's say your put was in the money. And let's say your put was something like this. Your put is at an 89 delta there, and your call is basically worth this something like this. What I would do is flip this again, and you can see down here now that it's giving us an overall credit now because the put is worth so much and we're selling that put. The call is basically worthless. So 630 is giving us in credit. I moved to the 14 days, so 7 days out. What I'm going to do is just set this up the same way first. I'm just going to go to the on the put side, the 105, and buy that. And then I'm going to sell on the call side, the 115. And so that's right here. And I know it's a zero bid and all of that kind of stuff, so just bear with me, but this is how it would work. And so because the market has dropped a lot, my put is kicked in and it stopped me from losing at the 105. And it stopped me from losing because what we said earlier is that the put gives you the right to sell at the strike price. And so if you have 100 shares and you have a put, well, they're offsetting each other. So you stop losing at the 105. But now you have this situation is that you're extending the trade. What do I do with these options here? How do I reset this? Well, most of the time, I'm going to try to keep my call as close to where I originally had it, the previous expiration period, so that if the market bounces back, which I said earlier it will, this is the S&P 500, then I want to try to keep that call as far away as I can. And sometime I'm going to be able to even take that call away, take it off. But in this example, you can see the debit is about $3. That's fine. I can move this down, and as long as I keep it above the 99, I'm going to still have no additional risk to the downside. But I'm just going to move this to the 102 in this example. I'm going to go from that, what was that, the 84 delta on the put side to a 70 delta. And that's going to give me an overall credit. It might be less than this because this is saying it's zero bid, but you get my point with the example. It will be an overall credit, and you still got the put in the money, and you're still protecting yourself to the downside. You actually reduce your overall risk because you got a credit. And so if it jumps back up, you still got all of that upside all the way back to this 115. And most of the time recently, guys, in recent history, and I say recent history, I mean all the way back to 2009, the markets come back and they come back fast. And so if that pattern continues to repeat itself, you want to keep your call at a good distance so you can participate with that huge rally back up once it's dropped. So these are 3 different ways you can adjust the collar strategy. Do you have to know any of these? No, you can still be successful at this strategy, but you will be so much better if you understand how to adjust these some.